X 100%. Engineer your financial freedom.
All right, let's jump right in. When you're building a portfolio, you're faced with this huge, fundamental choice. And honestly, it's a choice that can shape your entire financial future. It's the great debate, should you be an active investor or a passive one? So, here's the big question you've got to ask yourself. Are you trying to beat the market? You know, hunting for those hidden gems, those future winners that no one else sees? Or is it smarter to just follow the market, to ride its waves instead of trying to predict them? And this brings us to our two main players in this game. On one side, you've got the determined stock picker. This is your classic active investor, doing the research, trying to find the next big thing. And on the other side, the calm market follower. This person takes a passive approach, basically saying, hey, I just want to match what the S&P 500 is doing. Two totally different philosophies. Okay, so let's put them in the ring. Forget the philosophy for a minute. What does the cold hard data actually say about performance? Because this is where things get really, really interesting. So what are these active managers even paid for? Well, it all comes down to one little Greek letter, alpha. You can think of alpha as their edge. It's the extra return they're supposed to generate on top of the market average. It's the whole reason they get to charge those often very high fees. But here's the kicker, the part that might surprise you. Despite all the brainpower, the fancy algorithms, and the brilliant managers, the data shows this incredibly consistent trend. Over the long haul, most of them just can't do it. And wow, this slide, it really tells the whole story. The data from S&P is just brutal. Look at that first bar, the large cap funds. These are the biggest companies in the world. Even there, more than 3/4 of professional money managers fail to beat a simple, boring index fund. And it gets worse. As you move to smaller companies, it's a staggering 93% failure rate. It's like the harder they try to find an edge, the more elusive it becomes. And hey, don't just take my word for it. Warren Buffett, who is arguably the greatest active investor of all time, has said for years that most people should just go the passive route. His logic is just so simple. Why spend all your time and energy trying to find the single magic needle in the haystack when you can just buy the whole haystack? So, you've got to be asking, why is this so incredibly hard? Why can't these brilliant minds beat a simple index? Well, it turns out they're often fighting with one hand tied behind their back. And it's because of two massive performance drags, fees and taxes. Let's talk about fees first. All those expert managers and research analysts, they don't work for free, right? That cost gets passed right on to you in the form of something called an expense ratio. So before an active fund even makes its first trade, it's already lagging behind its passive cousin because of this fee hurdle it has to overcome. And this table, this right here, shows the absolutely devastating power of those little fees over time. So everybody starts with 10 grand. With a super low-cost index fund, that turns into over $66,000. Not bad. But now look at the bottom row, the high-cost active fund. The fees alone ate up almost $11,000. And your final value? It's over $24,000 less than the cheap fund. 24 grand! Just vanished into thin air because of fees. It's a silent portfolio killer. Okay, so fees are a killer. We get it. But believe it or not, there's an even bigger, stealthier predator lurking in your portfolio that most people totally ignore, and that's taxes. All right, let's look at a real-world showdown. We've got a top-rated active fund from JP Morgan going up against a simple Vanguard ETF. Now, on the surface, before taxes, it looks like the active fund is the champion, right? It made a little more money, the manager earned their keep, case closed. Not so fast. See, here's the dirty little secret of active funds. They're constantly trading, buying this, selling that, always chasing that alpha. And every single time they sell a stock for a profit, they create what's called a capital gain. And guess who foots the tax bill for that? Yep, you do. It creates this constant, nagging tax drag on your returns year after year after year. And now, look what happens when we account for the tax man. The tables don't just turn, they do a complete backflip. That winning active fund plummets down to $3.5 million. But the passive fund, it's sitting pretty at almost $4.2 million. The passive investor is now ahead by more than $635,000. It didn't just win, it was a total knockout, all because it was more tax efficient. And if you think that was just a one-off, think again. According to research from Wharton, this number is just staggering. Over the last decade, 97% of large and mid-cap active funds have failed to beat their passive competitors after you factor in taxes. 97%. The game is just completely rigged against you once you account for real-world costs. Okay, so after all of that, you might be thinking, all right, case closed, active investing is a total scam. But not so fast. Just because the data is overwhelming doesn't mean you have to give up on trying to outperform the market. It just means you have to be way smarter about how you do it. What if this whole debate isn't about active versus passive? What if it's not an either-or choice at all? What if you could take the best parts of both strategies and combine them? And that's where this really smart strategy called core satellite investing comes into play. The whole idea is to give you that low-cost stability of passive investing while still leaving you some room to hunt for that extra alpha with active managers. It's the best of both worlds. So here's how it looks in practice. The huge chunk of your portfolio, the core, is your boring, stable anchor. It's invested in a broad, super low-cost index fund. Then, around that core, you have your satellites. These are your explorers, smaller, targeted bets on actively managed funds in specific areas where you think a skilled manager might actually have a real edge, like biotechnology or emerging markets. And this strategy is powerful for three really simple reasons. One, it keeps your overall costs way down because most of your money is in those cheap core funds. Two, that huge passive core acts as a stabilizer, reducing the wild swings in your portfolio. And three, you still get to take your shots at hitting a home run, but you do it in a much more strategic, targeted way. All right, this all sounds great in theory, but how do you actually do this? Let's break it down into a simple, actionable plan you can use. It's really just a three-step process. Step 1, build your foundation. This is your core. Put the majority of your money, maybe 70 or 80%, into those broad, ultra-low-cost index funds. Step 2, add your explorers. These are your satellites. Dedicate smaller chunks to those active funds in niche areas you're excited about. And finally, step 3, which is crucial, rebalance. At least once a year, you gotta check in and make sure your targets are still on track. It keeps your risk in check. You know, when you boil it all down, it comes back to this one powerful idea. Before you factor in any costs, investing is a zero-sum game. For every winner, there has to be a loser. But the moment you add high fees and taxes into the mix, it stops being a zero-sum game and it becomes a loser's game for most people. So that leaves us with one final, really important question that you need to ask yourself. Take a hard look at your own portfolio. Is it really built to win this long game? Or could those hidden drugs of fees and taxes be silently eating away at your future wealth without you even realizing it? Maybe the best thing you can do after this is to go look up the expense ratio for every single fund you own. It might just be the most profitable 5 minutes you spend all year.